Hi, everyone. Thank you for joining us for HerCapital's virtual panel on investing. My name is Rabia Athar, and this is Zabreen Khan, and we are the co-founders of HerCapital. As you might know, HerCapital is a nonprofit with the mission to empower women to invest and to achieve financial independence. Before we get started, if you're planning to post about the event, please use the hashtag #MakeYourMoneyWork and tag us. For today's discussion, we will be focusing on the following topics. First, we'll give you an overview on investing accounts. Second, we'll be talking about building wealth and managing risk. And third, we'll be talking about ways in which you can supplement your investing journey. Finally, we'll have a live Q&A with our panelists.
Thanks, Rabia. We're so excited to host this panel today with three very inspiring women: Theresa Carey from Investopedia, Dr. Nicole Garner Scott from Amount Financial, and Duignan Minnihan from 1000 Angels. Thank you all for being here with us today. We're excited to get into it, but before we do that, I'll turn it over to you for quick introductions. Dr. Nicole, I'll have you kick it off.
Well, first off, hello, everyone. So excited to see this many women so invested in their future. And thank you so much to HerCapital for putting this on. During times like this is so needed, and you're creating such a safe space for us to continuously have these money dialogues. So really quick, I'm Dr. Nicole Garner Scott. I am the founder of Amount Financial. I do money coaching, and I've been an entrepreneur for over 15 years now. I've had the pleasure of being honored under the White House, under the Obama Association. I've been a TEDx speaker, and I'm just very, very passionate about helping underrepresented communities really expand their knowledge and resources as far as building their assets and creating long-term generational wealth, and really putting their legacies in place. So I look forward to talking to all of you today.
Theresa, why don't you go next?
Hi, I'm Theresa Carey. I'm the editor of Brokerage and Investing for Investopedia. Been there a little over 2 years, and prior to that, I was a contributing editor at Barron's for 23 years. I founded their digital investor column. I've been writing about online brokers since 1992, something like that, I forget. I'm really excited to be here, and it's been so much fun to meet Dr. Nicole and Erica, and of course, you guys at HerCapital. It's been quite a journey as we've set this up over the last couple months. So thrilled to be here. I started investing when I was 9 because I argued with my father about a stock he wanted to buy for me. And he goes, all right, you pick it. And I did, and it helped put me through college. So that was good. Anyway, thank you very much. Looking forward to helping you all learn on your journey.
That's such an exciting way to get started investing, Theresa. We've definitely done the same thing with our kids, which is pretty fun. So hi, everyone. My name is Duignan Minnihan, and I am the founder of startup investment platform 1000 Angels, as well as co-founder of seed stage venture capital firm Rain Ventures. I've been investing in companies that are essentially pre-seed through about Series B for the last, I believe it's 14 years now. So for quite a while. During that time, I've invested in hundreds of companies and have had the opportunity to work with thousands of really amazing entrepreneurs. For approximately 8 years prior to that, I spent my career doing investment banking at Credit Suisse First Boston, Citigroup, and Cantor Fitzgerald in a variety of roles of asset management, sales and trading, and traditional corporate finance. I also received an MBA in finance from Columbia Business School, where I also teach entrepreneurship. And I did my undergrad in business economics at UCLA. So really excited to talk to you guys about my favorite topic, which is money. So looking forward to it.
Thank you. Thank you to each of you for being with us here today. As each of our speakers let us know, their journey into investing was different. And the purpose for this event is to let all the women out there know that investing doesn't have to necessarily be for women in finance. It can be for women no matter what industry you're in. So whether you are in entertainment, whether you are an educator, whether you are in tech, it doesn't really matter, but having control of our finances is so incredibly important. And so today we're going to be learning from the experts, and we'll get right into it. This first question is for Theresa. As someone with 29 years of experience writing about finances and financial technology, can you walk us through what you tell someone who has no idea what investing is? How should they think about the various brokerage options available, especially those that are online with particularly low barriers to entry?
Excellent. The first thing I usually do when I am speaking to somebody who wants to get started investing is I ask her what her goals are. A lot of people don't start out thinking about their goals. They just start, they think, oh gosh, I should invest. And it's just not so much about wanting to invest. So my comment is, let's see, we can move on the slide and hit the next button. Anyway, is think about your goals. Why are you investing? And don't should on yourself, as I put it. Don't think you've got to do this because you should be doing it, because it's some, manifesto from above. I do encourage young people to get out of debt if they can. One of my kids is paying off a huge graduate school student loan, and she's also investing at the same time. So I'm very proud of her. During that journey, while you're getting out of debt, just make a habit of putting away even just a token amount on a regular basis. It could be $5 a month. It could be $10 a week. It doesn't really matter. It's a habit. And if you work for a company that allows you to enroll in a 401k program, just do it, even if it's just 1%. Your employer usually matches that. And so you get some free money. So what the heck, just go for it. When you're going it out there on your own, in order to buy and sell investments on your own outside of a 401k, you'll need to sign up with either a broker or a robo-advisor. Financial technology and the brokers now have made the market so much more accessible by eliminating minimums and in most cases eliminating a lot of the commissions, and also enabling fractional share trading, which we'll talk about in a minute. So brokers and robo-advisors have different legal setups. So brokers can buy and sell the investments and hold them on your behalf, but they do not offer advice. They might have some guidance. They might have some tools you can walk through. A robo-advisor, however, is registered as a financial advisor, and they can offer advice. And they have a lot of forms they have to fill out to do that. Brokers also will let you invest in a wide range of assets, such as, not just stocks and ETFs and mutual funds, but also options, bonds, sometimes other more interesting asset classes like futures and futures options, which are out there for the people who've been doing it for a while. And the robo-advisors set up a defined portfolio for you that has a focus on exchange traded funds and mutual funds. I think financial advisors have a great place in this industry. However, a lot of them really don't have a place for you as their customer until you've built up a certain amount of wealth. So when you're looking for a financial advisor, you might have to have $10, $15, $20, $50,000 first. So you can do that on your own. One way to ease into investing is by buying fractional shares of stocks or exchange traded funds. The cool thing about fractional shares is that you can invest really any dollar amount that you want at your own pace. You could buy $5 worth of Tesla or $5 worth of Apple. And you also earn dividends on those dividends, if any of them do pay dividends. I've got an account with a bunch of fractional shares at a broker called M1 Investing, and I get all these funny little 2-cent dividends every now and again. It's kind of entertaining to see that. You can also, most robo-advisor portfolios do contain fractional shares so that you don't have that much cash left over. It's all invested. On the downside of holding fractional shares, when you transfer an account to another broker, or maybe you just don't want to work with a particular broker anymore and you've moved on and you want to go somewhere else, Those fractional shares will just be sold. They can't be transferred. It's a regulatory thing. So you may pay capital gains tax on those fractional shares if you've been holding them for a while. But I think it's a great way to get started because you're not looking at, $1,500 for Tesla. You can buy $5 worth of Tesla.
Yeah, I think, Theresa, that's a really good point, because I think sometimes people are worried that they need to amass a lot of wealth before they can get started. And I think, if you think about buying fractional shares, like you said, you could have a few dollars and you can get started. And having a large amount of money does not have to be kind of the thing you need before you invest. So I think that's something we really want people to take away from today.
And I would also, when you're starting, look at broad exchange traded funds that let you have a piece of the whole market, and rather than an individual stock, just because it's less risky. It's a good way to get started. As you build your assets, you can then consider investing in individual stocks. I tend to ask people to avoid individual stocks until they have about between $25,000 and $50,000. Just, it's a risk thing. At Investopedia, we do a lot of reviews of online brokers and robo-advisors. We really dive deep into each particular characteristic, and our reviews are incredibly detailed. Sometimes I've heard from some people, it's like, oh, that's a lot. Skip to the part of the review you're most interested in. Anyway, we do, and we update these reviews every month. So on the first of the month, all of our reviews are refreshed. We've updated them with the latest capabilities of each broker. We just updated all of our online broker reviews in a completely new award cycle in March, which was a great time to publish broker reviews. And one of our subcategories was the best online brokers for beginners. And we looked at minimums, we looked at commissions, we especially looked at their education offerings and how easy the platform is to use, and how it keeps you from making any enormous mistakes. I really like the ones that stop you from doing something ridiculous.
And I think that's extremely important when you're starting out, is to have some kind of risk control, and not make those mistakes. So
absolutely,
that's significant. Sure.
Just overall, as a best broker for beginners, for their website, not necessarily, they have another trading platform called Thinkorswim that's really for advanced traders, but their regular green website, super easy to use, and it also has a fantastic education site with guidance on getting started, on setting your own goals and things like that. We like the E-Trade site, back up, there we go, for the easy trading experience and error checking and keeping you from stepping in it. And then at Merrill Edge, if you do want personal service, they have financial advisors in every Bank of America branch, which is their parent company. You can go in and get some personal service even if you've got $10 in your account. They don't care. So they'll talk to you. It's pretty nice. Then we also took a look at the best robo-advisors for beginners. And these specifically are ones with zero. You don't have to have any money to open an account. You can open an account and start using their tools. We really like Betterment and Wealthfront, as they have advice built in. Wealthfront is amazing. They're really, I'm very impressed with them. They were our best robo-advisor overall. Betterment's a little easier to use. Fidelity Go also has a zero minimum, and they put you in very simple portfolios that are easy to understand. Merrill Guided Investing and E-Trade Core portfolios are also extremely simple to use, easy to set up, and easy to get into. And I know not everybody watching is in the United States, so we also put together a little list here of brokers for those of you who are overseas, and that's the next slide. And so if you're in Canada, our favorite broker is actually Questrade, and they also have a robo-advisor built in. Charles Schwab allows people from all over the world to open an account and use them, and they also have a robo-advisor built in. Interactive Brokers Pro, super interesting platform, but again, this one's for much more sophisticated investors, although they're trying to work with newcomers. I think their platform's too hard to use. However, They have access to over 220 countries.
Wow.
And there's nobody like them. They're just far and away, that's the place to go if you really want to put together an international portfolio. TD Ameritrade is also accessible to people in over 100 countries. And I like Tastyworks for new options traders. If you're interested in trading options, that's a great place to go. Or their subsidiary, which is called Dough, D-O-U-G-H, in an app-based free trading app that's fantastic and has a lot of education built in. All right, that's about all I've got for now. Thank you very much.
Thanks, Theresa.
Put some questions in there if you've got some more questions for me for later.
Yeah, no, thank you. That was a wonderful overview. One of the questions we get so much is which app should I start with? Which one makes it easy for me? And I love that Investopedia breaks it down. And then the second most asked question is how do I invest if I am outside of the US? So I think that last slide there was particularly important. And for our audience, we will be sending a follow-up email that will include links to some of the more robust reviews that Investopedia has done on each of these brokers. So stay tuned for that. And of course, you can always rewatch this video to hear Theresa's input into all of the suggestions that she provided. But thank you for walking us through that. I think it's a great way to kick off this conversation. So this next question is for Dr. Nicole. As I know you've done some work on this subject and have spoken on this before, due to a lot of the recent events, systemic racism has been brought to the forefront of discussions in mainstream media, and people are finally starting to see how racism really is apparent in so many sectors, from healthcare to education, and of course, even in finance. Could you speak a little bit more about the racial wealth gap and how recent issues like COVID-19 have been exacerbating it?
Sure. So I can only scratch on the surface because we just have a few minutes. So definitely, if you want more information, I would invite you to really stay in tune with HerCapital. Also tag me at Amount Financial, and I can give more in-depth information surrounding this. But what's really important is I want to see really quick how much of the audience, how many of you are familiar with the racial wealth gap? Can you drop a 1 in the chat if you've heard of it before, if you're familiar with it, if you understand what it is, just so I can know where we're starting from. So just drop a 1 in the chat really quickly. Good, thank you guys. Okay, so just to give you some statistics. So leading into this year, I would say 2019, the Brookings Institute did a study, and the typical All-American white family net worth was at $171,000, while Black and brown families, the net worth was at $17,150. So almost 10 times the difference as far as family net worth. And in the last 90 days, due to the pandemic, these numbers have astronomically shot through the roof. And so many families that were already in a space of trying to keep financials together have completely, that system is completely bottomed out. And so I wanted to, I thank you so much for this platform, just to kind of bring this to light. A lot of financial specialists and teachers forget about the racial wealth gap when giving advice, right? So you might tune into a lot of people and you hear, you know, you just have to have discipline, or if I could do it, you can do it. And, you know, you just got to cut back on purchasing lattes and you'll get to where you financially want to get to. But we try to add context to that and show you that there's other things happening in society that lead to that unbalance. There's redlining when it comes to housing. So certain areas you can get houses and certain communities aren't left with that housing, or even we can look at the bailout that happened. When you look at the corporations who really benefited from the bailout, as far as the average American family that is still struggling during these times. And even looking at the job market, right? So there has been, unemployment is at its highest level right now, and it is highly impacting certain communities with this, and even in the school system. So a lot of kids are not going back to school in the fall. And if they're not in an environment where they have access to the things that they need to properly get through school, that widens this gap even more. And so I'm just going to quickly go through a few things that, if you feel like you want to participate in this, you want to help your family through this, you want to help your neighbors, your constituents, then I really want to just take a few seconds and talk about some legacy building opportunities and things that you should be doing right now to make sure that you can kind of start to turn the channel with this. So one thing that you can do is definitely making sure that you have your financials outlined and in place, right? Understanding what type of money is coming into your household, what's going out. We're definitely in a recession. So you need to be very aware. No more can we be the women that says, I don't do the numbers, or I don't, my husband takes care of that, or my boyfriend takes care of that. No, we know the numbers. Us at HerCapital, we are getting in the money all the way. So knowing your financials, having your will in place. So if you are 18 and up, I'm talking to you. Wills are not just for your grandmothers or for the senior citizens in your life, but so much is happening out here in the society with this pandemic that you want to make sure you have your will in place. There's a lot of property that's being lost back to the state for families that have members that are passing away, and they have nothing in writing to say that this property that I spent my whole life working for, I want to keep in my family. So having your will in place, having your tax information in place, having any information about a trust, if you have a trust, all these things need to be things that you are focused on, and making sure that you have your financial documents and your financial house in order so that we don't continue to widen the disparity that's happening. So those are just a few tips from me.
Thank you, Dr. Nicole. That was incredible. Thank you for speaking on the topic. I know that you've done a lot of research on this, and as Dr. Nicole mentioned, she is an expert who speaks on this quite a bit, and she has a lot of knowledge to share with the HerCapital community and other communities beyond as well. So, stay in line, follow her, and you can hear more if this is a topic that you're interested in. This next question is for Erica. Erica, I know that you are a private investor, so would love to hear from you. This question is a two-pronged question. But one, what are some tips you have for women who want to start their own business? And then two, for women who might be looking to make investments outside of the public markets?
Yeah, well, this is a great question and something that I'm excited to see more young women pay attention to. So, number one, it's great to invest in stocks and it's great to invest in other people's businesses, but, sometimes the best investment you can make is in yourself. So starting your own business can be a wonderful place to create either a robust primary source of income or potentially, what they call a side hustle or a second source of income, while also, just expanding your skill set in general. So certainly, I think it's a great option, something to add to your portfolio, as we say. But number two, at the end of the day, not everybody is going to be an entrepreneur. Some people, want to work. Some people want to start companies. We don't all have to do the same thing. But what I think is so important is for more women to be aware of the opportunity to invest in private businesses and become much more comfortable with the concept. So what you may or may not realize is that all the men out there, starting in college, but definitely after business school, are out there with their business ideas. And when they need that first round of capital, what we call the friends and family investment, they're going to the other guys that they graduated high school with or that they graduated from business school with. I can already, just off of the top of my head, think of 5 of my business school classmates from Columbia that have started billion-dollar businesses I've only been out of school for, I guess I graduated 15 years ago. So in 15 years, I already know at least 5 that have started companies and sold companies worth over $1 billion, plus many others who, are still growing their businesses. So really sort of paying attention to the people in your network, if you have it, and understanding that, hey, that friend of mine from school that had a great idea, maybe I want to invest in her company. How can I support her? And as women, we know that, you may or may not know, at least I know, that women typically receive, over the last decade or so, it's creeping up a bit, but we've always received less than 3% of total annual venture capital investment. And a big part of that is because we're not as culturally acclimated to the idea of investing in each other at the beginning, right? Giving each other that kind of initial layer of trust capital, betting on our sisters so that they can get to the next level and build these really large companies. So it's something to, I would say familiarize yourself with, think about, it just opens up a whole nother door for you, a whole nother avenue. And so I actually started a company 5 years ago called 1,000 Angels. And what we do on 1,000 Angels is we connect accredited investors, so people who want to invest in private startups, with startups that are raising money. And we typically start with these companies when they're raising between $1 and $5 million in capital. Now, people who are members of 1,000 Angels, they're already what we call accredited investors. So to be able to participate in this level of investing, you generally need to earn at least $200,000 a year or have $1 million in investable assets. So that may not be where you are right now, but if you're a young lady who's attending this seminar right now, I'm sure that within the next 5 to 10 years, you're going to get there. I have confidence in you. So what really makes sense to do in the meantime, right, as you're getting to that level, is to educate yourself about entrepreneurship and investing in startups so that when these opportunities arise, you're a little bit more open to taking advantage of them. I actually started a YouTube channel for 1,000 Angels where we provide loads of free investor training that is suitable both for entrepreneurs looking to raise capital as well as for people who are either currently investing in startups or are thinking about, wanting to be able to invest in startups in the long run. So as far as startup investing goes, I'd say that it's a critical part of our ecosystem. We need to learn about it so that we can develop the ecosystem, the capital ecosystem, both for female founders as well as for founders of color, right, to become much more familiar with the idea. And then we also need to just make sure that, once we're at that stage where we're accredited, that we're making really smart decisions around who we invest in and why. So certainly check out the YouTube channel. There are hours of trainings on there. You can learn all about how to either capitalize your own startup or how to start thinking about evaluating a friend of yours that might have a startup idea and how to be helpful to them.
Awesome. Thank you so much, Erica. As a fellow woman in VC, I definitely hear you on the points that you made, and that, there are so few women investors, there are so few women founders. And so I really appreciate your words of encouragement to get more women interested in this space and, confident in their ability to either invest in their friends' businesses, start their own businesses, or, just take that first step to really learn about the opportunities that could become available to them in the coming years. So
yeah,
thank
absolutely.
you.
And one more thing I'll just sort of jump in with before we wrap that up is that one of the great advantages of being aware of, private equity capital and venture capital sources that are out there is it actually allows you to take someone else's money and leverage it for your own benefit. So the guys are out there doing this all over the place. So I think as ladies, we really need to make sure that we're aware that this opportunity, can be for us and should be for us too.
Awesome. Thank you. So one thing that we get asked a lot is, the first few steps in starting to invest can often be the most difficult. And I know so much of our audience includes young professionals or recent college grads or even college students. And so, Dr. Nicole, this next question is for you. For students and other young professionals in particular, balancing debt while also saving and investing can be an obstacle to starting. So how does one build wealth while keeping, societal constraints or financial, other financial limitations in mind? What is the best way to take those initial steps and really take the jump while there are other things that we might be dealing with, like student loans or other forms of debt?
That's such a good question. And I'm going to take this time to really talk about building your financial portfolio. But definitely, if you have specific questions, go ahead and drop them into the chat so I can tap on them during my section of talking. But let's talk about your financial portfolio just a little bit. Are all of you familiar with the financial portfolio? Have you started putting yours together? Do you understand all the different ways to put your portfolio together? I just kind of want to see where the audience is. And for those of you,
I was going to say, Dr. Nicole, I would imagine it's a mix, but I would think most of our audience would err on the side of the starting out,
okay,
and thinking through some of these basic concepts.
Excellent, excellent. For those of you who are in college working on your portfolios, I salute you because you are definitely ahead. And for those of you who this is your first time hearing this, it's excellent because you are still very much ahead of the game of many of your counterparts. So let's talk about really quick some of the different areas when it comes to building out your complete financial portfolio. So I want to start with your balance sheet. Putting together your balance sheet. So understanding once again what your numbers are, what's coming in, what's coming out. And because there's so much technology now, this is so much simpler than it was, a few decades ago for your parents' generations or your parents' generations, where everything was done on pen and paper. But now you have great technology. So if you want to utilize a website like mint.com to start creating your budget, or you need a budget.com. Those are excellent technology pieces where you can really start to figure out your balance sheet, get a better understanding and a closer look at your money so you understand what you're doing with it. And what's really important is that you want to, especially during these times, you want to assign every dollar a task, right? And I call it zero-based budgeting. And so you want to make sure that every dollar that's coming into your life, you give it something to do, whether it's going to your savings, whether it's going to investing, whether it's going to school, books, food, whatever that is. Because if you don't assign it a dollar, it'll create its own task. The same as when someone gives you $100 bill, and as soon as you start to spend that $100 bill, all of a sudden you get to the end of the day and you have $5 left. And you have nothing to show for it. Like you got extra ice cream, you bought a handbag that you don't even really need. You did all these random things with your money. And that's because you weren't intentional with how it was spending. So when we're in times like this, you want to, even when the economy is booming, you want to make sure that you really understand where you're putting your emphasis on your dollars and how you're contributing to the things that you're saving for and your future goals. Next, your 401k. And so you have to remember when it comes to like your 401k, your Roth, and these different things. For those of you who are in the workspace now, you just started in the workspace. I know these last few months, a lot of the numbers have been looking very crazy and it's been making you very nervous just about your investments overall and understanding the economy. But the economy always works in a cycle. There will always be highs, there will always be lows. And so many of these things that you're doing when you're contributing to your 401, when you're, putting money away in these places, you always want to remember that this is for the long run. This is not something that you want to hurry up and pull your money out and get nervous about and, act out of fear, because the economy goes in cycles. And so it'll return again. Paying off your credit cards and your debt. And so usually I'm very much a big proponent of speeding up that. But when we're in a recession, you want to be very cash strong at this time. So you want to work things out where you're paying on it, you're staying current, but you probably want to scale to doing minimal payments if you are worried about your job or worried about your income in any way. Because the goal is to stay very, very cash strong, making sure that you have cash reserves at this time and staying very focused on that. Building your 6-month emergency fund. So I want to go ahead and take that up to 8 to 10 months right now. Given that the workforce and the work economy is so different, and there's just a lot. I mean, this is just a time where we don't know what's going to happen the next day, right? Like I'm in Florida right now, and so a while ago Florida was doing great, and now Florida is like the epicenter of the epidemic. So this is why virtual is great for me, because I'm not leaving the house. But understanding that you want to make sure that you have your emergency funds in place. And it's even great to look at high yield interest accounts and ways that you can have that money make money for you. But that's just liquid money, so that anything that pops up in your life does not become traumatic, right? So if there's something that you need, if something happens with school, a lot of my interns, they had to hurry up, pick up, move back home. If you have some money saved, then that's an easy thing. If you don't have money saved, then that becomes a very traumatic thing. So making sure you have that in place. Looking into other investments, seeing what you're comfortable with. And Theresa did a great job of just letting you know how to start to get into those investments, whether you're starting through using the Robinhood app or the Stash app. And I know she'll probably talk about that a little bit more too, or getting to places where you can even get into real estate investment or things that you feel comfortable with. What I don't want you to do is feel the need to jump on the trends or feel the need to throw your money at anything out of fear right now. Every investment is a risk, a large risk. And so you want to make sure that you are very much doing your research. You're aligning yourself with professionals. You're putting yourself in the most educated way possible, because we don't want to lose money right now. We don't want to just throw money down the drain. So you want to have that in place. Investing in yourself, which is, we discussed a little bit earlier, just if you don't consider yourself an entrepreneur, after tonight's course, you should be an entrepreneur. There should be a second and a third stream of income coming your way in some type of way, because the typical corporate America, you can't put all your eggs in that basket. And so you just want to make sure that you have other ways and other means of bringing in money. For those of you who might have children, saving for your children's education, you could do a custodial IRA for your child. You can do a 529, looking into both of those options as ways of having tax vehicles, so you don't have to pay taxes on the money you're saving for them. And then what's really important is, because the world is changing so much day in and day out, is to really stay the course, really keep yourself aligned with I call them wealth positive friends, the people that you're meeting in HerCapital community, the women that you're meeting, that are just into money, into talking about money, into just trying to change the trajectory of where they're going with their money story. These are people that you want to continue to build with. You want people that celebrate. When you pay off your car, it should be a celebration. When you pay off your house, it should be a celebration, not people trying to deter you from those goals. So your community, your tribe is going to be very strong as far as accountability and help you reach those goals. So those are just a few steps and tips on building your complete portfolio.
Dr. Garner, I think you brought up a really important point, which is that, in this current environment, it's particularly important to think about the risks that investors are facing, particularly young investors that are just starting out. And that brings us to our next question. That's for you, Erica. Young and new investors are always sort of thinking about market volatility and sometimes not enough and sometimes too much. So for people that are watching today, what are some thoughts or tips from your perspective for how young investors can, one, manage their risks, and then two, also size investments so they can weather storms or market downturns, for example, like Dr. Nicole just mentioned?
Yeah, absolutely. Well, it's a tricky question because when you're dealing with a small portfolio, there are, sort of different dynamics involved. So, number one, I would say that everyone should have, at least 3 months of expenses saved in an emergency fund in cash, right, to be able to, weather a certain amount of storms. And as we've seen, this most recent storm has lasted for longer than 3 months for a lot of people. So making sure that you have at least that cushion, I think, is important. And then the second thing is that when you're starting to build a portfolio, you really want to be investing in blue chip stocks that, probably are lower volatility. So if you look at all of the different opportunities for investment in the market, you get very high volatility opportunities, and then you have some of the more solid, solid bellwether stocks. So I would say, think about how much you're okay with losing, right? And if your stomach's not going to turn if you lose, say, 30% of your portfolio, that's probably what you can place into some of the riskier single stock bets, and the rest of the 70% should probably be more like in an index fund ETF, right? So very simple, you're probably dollar cost averaging, maybe every paycheck or every other paycheck you're going into the market. That will help you ride out some of the volatility, because, even if you invested when the market was up and then, it drops by, 3,000 points, right? Next month, you'll be buying down at that lower level and hopefully participate in the upside. But the important thing to remember is that, there are never any guarantees. If you look at the NASDAQ, it took, after the crash of 2000, it took 15 years for that index to recover. So your money is always at risk. But of course, there is no gain without risk. There's no upside without risk. So I would be protective. I would use index funds. I'd use low cost index funds that have a decent amount of trading liquidity. And then whatever you're sort of willing to, put at risk, you can put into sort of those cool stocks that you're really excited about, maybe a Tesla, or maybe you love Netflix, or, whatever it is that, probably has had a bit more swings going on to feel comfortable with. Another thing that I think is really crucial, though, is to think outside of the stock box, right? So there are not only opportunities to invest in public market equities, but you can also invest in REITs. You can also invest in bond funds. You can invest in MLPs. I mean, there are probably, 18 different asset classes that all have ETF type securities that you can use to diversify your portfolio. And then on top of that, of course, there's the opportunity for real estate investing. And even if you live in an area where maybe you can't afford your own home right now, there are lots of areas in this country where you can buy an investment property, for maybe even under $100,000, right? With a mortgage, you might only have to put about $20,000 down period, and maybe that turns into something that you can Airbnb or you can rent out for rental income. So really sort of thinking about all the different opportunities to create wealth, to build wealth, and to really make sure that whatever investment you're going into, particularly when you're just building your portfolio and you're new to investing, that you're approaching it with a buy and hold attitude. If you're bullish on Disney now and you're going to buy, 5 shares of Disney, put that in the account. Don't look at it for the next 10 years, and then 10 years later, when it's time to, pay for your kid's private school or put a down payment down on your house or, whatever it is, then you can go back and say, is this something that I want to liquidate? So I think that's a great approach to managing risk.
Thanks, Erica. I know in the comments, we're getting a lot of questions from women who are asking, what are index funds? What are ETFs? And just want to be cognizant of time here so that we can get to, a lot of the other questions. This is such a big topic, and so we will continue to have more events covering some of your questions. We will be sending a follow-up email, and we encourage you to follow along on our Instagram as well as on our website, where we really distill this information down and provide some of those definitions and have more longer form content that alludes to a lot of what our panelists are speaking about today. So just wanted to put that out there. I know that we're throwing a lot of information at you, but hopefully this is helpful in preparing you and giving you the confidence to kind of go out there and continue educating yourselves on the topic of investing. And we'll continue to have events on this topic as well. So just wanted to share that. And then this last question is for Theresa before we move into answering some of our live questions. What are some of the biggest mistakes, in your experience that you have seen new investors make when they are first starting out? I think it's always helpful to know, what those red flags might be when you're starting out, so that you can avoid them. And given that, the three of you are so experienced, I'm sure you've seen some of those red flags. So would love to hear from you what those mistakes look like.
The biggest mistake I see is somebody dumping all their available cash into a single very risky stock. I just had a guy on Twitter ask me if he thought he did the right thing by taking his $1,200 stimulus check from the government and buying part of a share of Tesla stock. And I'm like, oh my God, that's all you did with it? You took that whole thing and put it, oh geez. And yeah, that day he made money, and then the next day he lost a third of it. So it's just, that's not a good thing to do. To take all of your money and put it in one place. A great app for people when they're just starting out is Stash. It helps you not only track your cash, but put your change into some exchange traded funds. I am happy to go into more detail. If you want to follow me on Twitter and ask specific questions, my handle's TW Carey, TWCAREY, and I'm there all the time, pretty much. Anyway, I just think watch out for those super risky, high-flying stocks when you're just starting out. Watch out for, I do like the options market, but again, I want you to be a little further along your journey before you start playing with options. I was quite a ways in, but the tools weren't there for me until I was in my 40s to invest in options online. And I've had some amazing success there. But again, I started out with a couple of years of income stashed away in various liquid ways. I'm also going to second Dr. Nicole's idea of having a second or third stream of income and encourage any of you who played a sport in high school or college to look into refereeing. I'm a college volleyball referee in my copious free time, although I've had no refereeing since the beginning of March. Thank you, COVID. And I really miss it. I miss the athletes, I miss the games. I'm earning the same amount you would earn a year after you started refereeing as a ref. So it's one of those things that you can really do as much as you have free time for. Anyway, I do like Stash. It helps you figure out where you're spending your money and put your change away. There's a robo-advisor out there called Elvest that's aimed at the particular investing issues for women. The only problem with them for you guys, new investors, is that their minimums are high, but they do set up some really interesting portfolios that take into account the fact that women live longer, that we tend to have other people that we're caring for as we age. I'm the conservator for an aunt with dementia. That's super fun, but every month I got to pay those bills. And so it's one of those other things that's going to happen further on down the road.
That's super helpful, Theresa.
That's where I'm at.
Yeah,
So,
no, that's super helpful. And I think you guys are being very generous, offering up your time to our audience for questions after the fact. But I do want to have at least, we were running short on time, so have at least 13 or so minutes for some audience questions. So what we will do is pass over to one of our programming team members, Ava, who will be taking questions from the audience.
Well, hello everyone. So I'm just going to begin with a question that was submitted earlier via our Instagram and then get right into the live questions because there are definitely a lot of them. So I want to squeeze in as many as I can. So anyone can take this question, but a lot of people were asking about basic money habits that you would encourage us to develop as it relates to investing, especially since habits are such an important aspect of financial well-being and health.
Nicole, I think that's you.
I'm sorry, could you repeat that question one more time?
Yeah, so basically, what are just some basic money habits that you would encourage people to develop as it relates to investing?
So first, having a true understanding that it's a lifelong learning opportunity. And so really getting into reading books, listening to podcasts, listening to shows, really having an understanding of the knowledge side of it as much as possible. Second off, understanding that you can't lead with your emotions when you get into the investing space. So for many of us, especially as women, we tend to hop into our emotions. And with this type of economy, that could literally drive you insane. So you understand that. Three, definitely seeking out and putting together, I call it your dream money team. So figuring out who are the professionals, where are your weaknesses, where are those opportunities that you have, and how can you surround yourself around professionals or mentors or people who have the knowledge to help you get to where you want to in a proper way. Because the thing is, there's so much information, especially in the financial space. It's almost like you can listen to a podcast and everyone is contradicting each other, and you're getting one set of information here and turning on the news and getting another set of information. So you really want to understand who has the best information that you're seeking that applies to your situation. And then I would lastly say understanding what your risk tolerance is too, because something might be a great opportunity, but if it gives you a heart attack in the meantime, then that's not good for you. You want to make sure that through all this financial talk, you're still doing what's good for your mindset, and you're still doing what's good for your peace of mind throughout this process too. So understanding your risk tolerance and understanding some of those things. Now, I'm gonna add one last thing too. Understanding your financial triggers is very important as well. I think a lot of us separate what we're going through emotionally from it reflecting itself and showing up as symptoms in our spending. And so, a lot of us through the pandemic started ordering from Amazon every day. Every day you open the door, you have a new Amazon package. And it's because it's triggering off of something else. Maybe it's fear. Maybe you're watching the news all day and you're consuming that fear, and it's turning into making you want to spend because you feel like you can control in that area. But if you get really, really good with understanding what your triggers are and recognizing them when they show up, then you won't do the toxic financial behavior to try to counteract that.
Thank you so much for taking that question. I know.
I just want to follow up really quickly there too. I really think that for those of you that are in a position, if you do work for a firm that provides a 401k and particularly a 401k match, probably the best, healthiest financial habit that you can establish is to, max out that contribution if possible. Over time, that'll really be impactful.
Agreed.
Yeah, thank you. And I'm just going to kind of, shift gears into some of the questions asked by our college students. Someone asked, how do you suggest going about investing if you're someone who doesn't have a steady income because you're just out of college and going into grad school? I know a lot of people, obviously, they want to invest, but they're still hesitant, especially because the income isn't really steady because they're in and out of school.
I can answer that one. I was self-employed for 34 years and my income was all over the place. I'd have a huge month and then I'd have a 0 month. But what I did was make a point of taking a certain percentage of every check that I received and setting it aside. I put away 10% into my cash account, and then I would put 5 to 10% in one of my investing accounts. And I just got in that habit, and as I said, self-employed until 2 years ago, when now I have a salary, and it's weird to go, oh my God, it's the same amount every 2 weeks. I'm really not used to that still. So, although my refereeing income is all over the place, and I do the same thing with that. When I get a check for refereeing, 10% into cash savings, 10% into usually my IRA. I've been putting as much as I can into my IRA because that can grow without being taxed.
And Theresa, on the back of that, how do you think about kind of some of the fixed costs that maybe when you're budgeting, you can't necessarily put those into percentages? So how do you combine that with, say, 10% saving every single time?
Oh, yeah. Well, that probably goes back to right after my husband and I bought this house, and we had about $180 a month after all of our housing expenses. And at that time, I just looked at it and went, I'm going to save 5% of whatever. whatever it is at the end of the month. And okay, I'm going to buy whole chickens and cut them up rather than in parts, because that saves me at that time, 70 cents a pound. So I was really good at saving money for a long time. I'm not as good anymore because I'm more comfortable, and I don't have to watch every penny, but boy, do I remember that. And a lot of it for me is letting my inner control freak just go wild and make sure that I know where every freaking penny is going. And I did for probably 25 years. I could tell you where every penny went. And I love Dr. Nicole's line about how every dollar has to have a purpose. I think I was doing that without using those words. And I was like, oh my gosh, that's such a great concept. And so I would just say, the less money you have, the more of a control freak you've got to be. And we all have, if you've got one of these little cell phones, you've got a way to keep track of what your spending is, especially since we're doing so little spending with cash anymore. It's all on an app or Zelle or Venmo or whatever. You can track those. And yeah, find your triggers, know what they are. A lot of us get into emotional spending. And whenever I have to cut back, I look at, oh gosh, I'm spending too much on, X, I don't know, manicures, back off, and that kind of a thing. So it's just good to know yourself and know what makes you open your wallet and buy something. So I hope that helps.
Yeah, thank you. And as a college student myself, it's really helpful to hear those tips. I don't have a steady income, obviously, but just knowing that doesn't prevent me from investing is definitely really motivating. And we also had a lot of questions, speaking of college students, about retirement accounts. And is it smart to invest in a retirement account as early as 18? And how do I go about that?
So I can jump in on that one. But ladies, feel free to jump in too. But I truly believe that the primary driver of investment return is time. And so the fact that you're thinking of this at 18 makes me so excited and so happy, because you're about to enter into one of the natural wonders of the world, and that's compounding, right? And so for those of you, if you understand what compounding is, excellent. If you feel like, woo, what is that? Then please Google it as soon as we hop off of this panel. But compounding is seeing your money grow over time. And so if you're starting at 18, you will see so much of a return on that investment when you reach 40 and 50 years old, as opposed to someone who starts when they're 30 and as opposed to someone who starts when they're 40. So I commend you for even asking that question. And yes, you should start when you're 18. All that you need to have in place is earn income. So if that's a part-time summertime job that you have right now, if that's your entrepreneurial business, whatever that is, as long as you can show that you have earned income, and then you could contribute up to $5,000 of that earned income to your Roth or IRA. So these are things that are very important. One more person kept saying that they didn't understand what a financial portfolio was. And that's a word we've been using through this whole process. So I wanted to just get that out there really quickly. But your financial portfolio is your financial assets. And so when it comes to what is an asset, it's the things that you own that have financial value, as opposed to the things that you owe money on. So I hope that's layman's terms and can help you. But I know we keep using that word throughout this. So I just wanted to put us all on the same playing field really quickly.
Thank you so much for clarifying that definition as well. I just want to ask one more question and direct it towards Erica before we wrap things up. As an entrepreneur yourself, you've given some tips you have for women about how to start their own business. But of course, if you have any more, please feel free to add. But also, as an investor, what do you look for in a startup investment?
Yeah, that's a really great question. So, there are a lot of different ideas that can be great businesses. but not all of them are investable. So for us, what we're looking for are, number one, an amazing founder, right? It has to be a founder and a founding team that we think can potentially build $1 billion business. And by the way, I just want to thank Nicole and Theresa for all the shout outs to Stash. That company was actually founded by a really good friend of mine who's one of my neighbors and was one of the first investment opportunities we had on 1,000 Angels. So they definitely got there. So we're looking for scalable businesses in industries, that can potentially reach $1 billion market cap. We're looking for, folks who can build a strong management team, build a strong brand. And, most importantly, we're looking for people, who are solving big problems, right? So, you can certainly solve a small set of problems and create a lifestyle business, a business that's enough to support yourself. But to really be something that's investable, you need to be solving a very large problem that creates a significant pain point for people. And that also, is felt on a relatively mass scale. So, I'll give an example with Stash, why, that company made so much sense from the beginning. Well, back when the company was founded in 2015, number one, we had just come out of the 2008 financial crisis. And at that point, to these, millennials, and I guess not really Gen Z people, but sort of, millennials and younger millennials, all of the bank brand names had terrible brand equity. So none of these millennials wanted to be, at a Goldman or a Citigroup or Wells Fargo or a B of A, all of these people that they viewed as the villains that had taken down the financial system. So the opportunity to create a new bank brand from scratch was huge. And they were one of the first people who actually were able to do it on mobile, right? 5 minutes and $5, you can start investing in stocks. So it was a great market opportunity because it was infinitely scalable, right? It really solved a huge pain point for younger kids who wanted to invest. And there was opportunity for value capture because the financial crisis had really tarnished the brand names of the big entrenched, competitors. So, that's just one example of sort of a setup that makes a company, an obvious yes for an investment. But at the end of the day, every opportunity is different. And no matter what problem you're out there trying to solve, trying to build a business around, keep working on it, keep iterating, talk to early stage VCs. I'm sure Sabrine would love to give you some feedback. I would love to give you some feedback. Talk to people who have experience in that specific industry, and you'll be able to sort of figure out how you get to your big opportunity.
Thank you for answering that, Erica. I know a lot of people my age are, really interested in, creating their own startups. So that just gives them a really great insight into, how can I make my startup investable? So I really appreciate that. And unfortunately, we are a little bit past the hour. So we have to wrap things up. And thank you so much for everyone who's tuning in today. And a big, big thank you to our wonderful panelists. We covered a lot, and they provided their, their valuable insight to our diverse audience members, and I really appreciate that. And yeah, I hope this event provided a useful overview on the importance of investing. So please stay tuned for more information on an additional event that we will be hosting next month, which will provide more detailed information on the mechanics of investing along with step-by-step how-tos, because I'm sure a lot of you want, more of the nitty-gritty, and that will be coming up in an event shortly. And of course, don't forget to follow us on our social medias to stay up to date, where details of the event will be released, and just other things like that. Again, thank you so much for joining us. We look forward to seeing you again for our next session soon.